Welcome fellow traders to this comprehensive video on risk management in forex trading. First of all, let me introduce myself. My name is Anthony as trading analyst of Prime Codex and have been experienced in trading for about 6 years, and I'll be your speaker today. In today's webinar, we're going to explore the vital concepts that can make the difference between success and failure in the forex market. Alright, let's dig into it. So what are we going to discuss today? We'll be discussing about first, what is risk management? Second, we'll talk about how much trading capital you need. And the next, understanding drawdown and maximum drawdown in forex trading. And lastly, the reward to risk ratio. But before that, an important disclaimer. All information is being presented for educational only purpose. Any information in this video should not be construed as containing investment advice or investment recommendation. Alright, let's jump to the first topic. Understanding risk management. To start, risk management is the set of strategies and practices traders employ to protect their trading capital while maximizing their profit potential. Forex trading involves the buying and selling of currencies in the global market. Due to the high volatility and leverage involved in forex trading, it's essential to have a well-defined risk management strategy in place. Without proper risk management, even the most brilliant trading strategy can lead to significant losses. And next, let's understand the key component of risk management in forex trading. First is position sizing. Determine how much of your capital you're willing to risk on a single trade. This is often expressed as a percentage of your total capital, typically ranging from 1 to 3%. For example, if you have a $10,000 trading account and decide to risk 2% per trade, your maximum risk per trade would be $200. Second is stop loss orders. A stop loss order is an instruction to automatically exit a trade if it reaches a certain price level, limiting your potential losses. Set your stop loss order at a level that aligns with your risk tolerance and trading strategy. Avoid moving your stop loss further away once the trade is open, as this can lead to larger losses. The third component is take profit order. A take profit order specifies the price level at which you want to exit a trade to lock in profits. This helps prevent greed from clouding your judgment and ensures that you capture gains when the markets move in your favor. Next up is the risk-reward ratio. Before entering a trade, calculate the potential reward relative to the risk. A common risk-reward ratio is 1 to 2, which means that for every dollar you risk as your stop loss level, you aim to make $2 in profit. This ratio helps you assess whether a trade is worth taking. Next is diversification. Avoid putting all your capital into a single currency pair or trade. Diversifying your trades across different currency pairs can help spread risk. If one trade goes against you, others may still perform well, reducing the impact of losses. Another key component of risk management is risk tolerance. Understanding your risk tolerance, which is your ability and willingness to withstand losses. Your risk tolerance should align with your overall financial situation, goals, and trading strategy. Don't take on more risk than you can afford to lose. After that, you need to have a trading plan. Create a well-defined trading plan that includes your risk management rules, entry and exit strategies, and also trading goals. Stick to your plan and avoid impulsive decisions driven by emotion. Next, be careful of the use of leverage. Be cautious when using leverage as it can amplify both gain and losses. Only use huge leverage if you fully understand how it works and can manage the associated risk. After that, you need to conduct monitoring and review. Continuously monitor your trades and adapt your risk management as market conditions change. Regularly review your trading performance to learn from your mistakes and success. The other important component that often underestimated by traders is emotional control. Keep emotion like fear and greed in check. Emotional trading can lead to impulse decision and poor risk management. Stick to your predetermined plan. Lastly is the risk-reward assessment. Assess the overall risk in your trading portfolio. Avoid over-concentration in a single currency pair or market segment. Ensure that your overall risk exposure aligns with your risk tolerance. Next, let's talk about how much capital do we need in trading. This is a question that often arises when we first delve into the world of forex trading. Determining how much trading capital you need is a critical step. It should be an amount you're comfortable risking without affecting your financial well-being. So how much capital do you need? Many experts recommend risking no more than 1 until 2% of your trading capital per trade. As a general guideline, many professional traders recommend having at least $10,000 to $20,000 in trading capital if you're looking to trade forex seriously and professionally. However, some traders start with less and gradually build their capital as they gain experience and demonstrate consistent profitability. Ultimately, the amount of capital you need will depend on your individual circumstances and trading approach. After talking about trading capital, another key concept you need to understand is the maximum drawdown. But what is drawdown? Drawdown refers to the decline in your trading account balance from its peak to its lowest point. This is a natural part of trading. Maximum drawdown, on the other hand, represent the largest drop from the peak balance. Managing drawdown is crucial to preserve your capital during rough market periods. Drawdown calculation. Here's how maximum drawdown is calculated and what it represents. Maximum drawdown in percentage is equal to peak value minus true value divided by peak value and multiplied by 100. Peak value. Identify the highest point or peak in the account's equity during the specific period. True value is find the lowest point or trough in the account's equity that occurred after the peak. For example, if a trading account had a peak value of $10,000 and a trough value of $8,000 during a specific period, the maximum drawdown would be 20%. This means that at its worst point, the trading account lost 20% of its peak value during that period. Next, let's talk about risk-reward ratio. The risk-reward ratio is a fundamental concept in trading and investing that helps traders assess the potential profitability and risk of a trade. It's a ratio that compares the potential reward of a trade to the amount of risk taken. Traders use this ratio to make informed decisions about whether a trade is worth taking. Now let's look at few examples on risk-reward ratio. First is 1:1 risk-reward ratio. In this scenario, you are risking the same amount as your potential reward. If your risk is 50 pips, your potential reward is also 50 pips. This means that for every trade you win, you need to win another trade just to break even. Next is 1 to 2 risk-reward ratio. This is a commonly used risk-reward ratio in trading. For every unit of risk, for example 50 pips, you aim for a potential reward of 2 units, as in 100 pips. This ratio allows you to have a winning outcome even you are correct in your trades less than half the time. So how to calculate reward to risk ratio? Calculating this ratio involves identifying the distance between your entry point and stop loss and comparing it to the distance to your take profit. A higher ratio often signifies a trade with a better potential payoff relative to the risk taken. It's important to note that a good risk-reward ratio should be part of broader risk management strategy. It helps traders control potential losses and avoid overextending themselves on high-risk trades. However, should be used in conjunction with other risk management techniques, such as proper position sizing and setting stop-loss order to effectively manage risk in trading. The next is position sizing. Position sizing is the cornerstone of managing risk. It involves determining the trade size based on your risk tolerance and the distance to your stop loss. This prevents any single trade from excessively impacting your account. Next, let's talk about leverage and its impact on your risk. While it can be enticing, it's crucial to use leverage wisely. High leverage increases your exposure to risk and potential drawdown. Consider lower leverage to maintain better control over your trades. Next up, diversification as the strategy to spread risk in trading. Diversification involves trading different currency pairs to spread out risk. While it doesn't eliminate risk entirely, it reduces the impact of a poor performing trade on your overall portfolio. Another key aspect that you need to be aware of is the importance of emotional discipline and risk management. It's not an exaggeration to say that emotional discipline is backbone of risk management. Fear and greed can lead to impulsive decisions. Stick to your risk management plan regardless of market fluctuations. And the next, you need to do continual review and learning. Regularly reviewing your trades and analyzing their accounts helps refine your risk management strategy. Learn from both successes and failures to evolve as a trader. Okay, so we have arrived at the very end of this session. To conclude, remember that successful forex trading hinges on effective risk management. Develop a robust plan that includes proper position sizing, reward to risk assessment, and emotional discipline. By doing so, you'll be better equipped to navigate the complex world of forex trading.